Hello, everybody. My name is Wes. I'm your financial advisor coming to you from the Florida Keys. Now, diversification is one of the most commonly used words in investing, but also one of the most misunderstood. Most people hear diversification and think it means safety, protection, or that losses somehow won't occur. That's not what diversification actually does. So in this video, I want to clearly explain what diversification is, what diversification does, and just as importantly, what it does not do. Because when you understand this correctly, it changes how you react to markets, how you evaluate portfolios, and how you manage expectations over time. Let's jump right into it. So what actually is diversification? Well, at its core, it's about spreading exposure across different investments that behave differently from one another. Make this clear, it's not about owning more investments, but owning things that respond differently to the same events. This could be different asset classes, different sectors, different geographies, maybe even different risk drivers. But the goal is not to eliminate risk. The goal is to avoid having all your risk concentrated into one place. Never have all your eggs in one basket. Now, the most important thing diversification does is reduce the impact of any single investment on your overall outcome. So if one investment struggles, it does not get to define the entire portfolio. Diversification also helps to smooth results over time, reduce extreme outcomes, or lower the likelihood of permanent damage from one bad decision or one unexpected event. Now remember, it doesn't prevent losses, but it helps prevent catastrophic losses. Think of it as lowering the stakes of individual outcomes, but not guaranteeing a positive one. Now, very important slide. What does diversification not do? Well, diversification does not prevent market declines. It does not eliminate volatility, and it certainly doesn't guarantee positive returns in every year. A diversified portfolio can still go down in value, sometimes significantly. But that's not a failure, that's just normal market behavior. And diversification does not mean you avoid discomfort, it means you avoid putting all of your discomfort into one basket. Now, one reason people question diversification is because it often feels underwhelming in strong, bullish markets. When one sector or one asset class is soaring, diversification often feels like it's holding you back or it's restricting your gains. But that feeling usually comes from short-term comparison and not actual long-term planning. So diversification trades the possibility of extreme outperformance for a higher probability of long-term consistency. And consistency is what compounds, not the excitement of the moment. Moving on, what actually is the difference between concentration and diversification? Well, concentration is not inherently bad, but it is inherently fragile. When your outcome depends heavily on one company, one sector, or possibly even one theme, you're accepting a much narrower range of possible futures. Diversification attempts to widen that range. It doesn't promise the best outcome, but it does improve the odds of a reasonable outcome across many different investments. And that is an important distinction to make when setting up your own portfolio. Diversification works over time, not in granular moments. In any single year, or even a couple of years, it may not look impressive. It may not look like diversification has paid off. But over full market cycles, diversification helps manage uncertainty, human behavior, and the reality that we don't know what will outperform next. Diversification is an admission of uncertainty and not a weakness, but rather a discipline. The real value of diversification isn't just mathematical, but also behavioral. A well-diversified portfolio is easier to stay invested in. It also reduces emotional decision making, and it helps investors stick with a plan. And staying invested matters more than finding the perfect investment. To wrap all this up, diversification doesn't eliminate risk, but rather organizes it. It doesn't prevent losses, but it helps prevent one mistake, one event, or one market cycle from defining your financial future. And diversification is not really exciting, it's not flashy, but it is one of the most reliable tools we have for navigating uncertainty over long periods of time. And in investing, uncertainty isn't the exception, it's the environment. I thank you all so much for watching. I really appreciate you tuning in. As always, I'm trying to improve my craft. So if you have any recommendations for me, you believe I could improve on anything, please let me know in the comments below. Have a wonderful day.